$118 billion.
It just sits there on the page, doesn't it? It's a number so big you have to, blink twice to make sure you're seeing it right.
It's massive, and we talk about big numbers all the time here. You'll get tech companies and their projections 5 years out, but those are often, well, they're hypothetical.
Right. There's spreadsheets of what if.
Exactly.
Yeah.
This is different. This isn't a projection. It's a backlog. It's signed contracts. It's a legal promise to build things.
It's a guarantee of future work. And when you see a number like that, 118 billion, attached to a company like General Dynamics, it tells you something really specific about the state of the world. It's a signal.
It feels less like an accounting number and more like a geopolitical weather report.
In a lot of ways, that's exactly what it is.
So let's unpack this. Welcome back, everyone. Today is Wednesday, January 28th, 2026, and we are doing a deep dive into General Dynamics Q4 2025 earnings. We've got the call transcript with CEO Phoebe Novakovic, the press releases, the slides, the whole package.
And look, I know defense contractor earnings can sound pretty dry. Most people probably picture a bunch of accountants high-fiving over profit margins. But this report, it feels different.
How so?
Because what we're seeing here isn't just a company making money. We're seeing three huge engines all firing at once. You have high-end private jets, which tells you about the global economy. You have a European continent that is rearming at a shocking pace, which tells you about global security. And then you've got a submarine manufacturing boom that's finally finding its feet.
The sheer scale is what got me. But before we get lost in the weeds of, submarines and tanks, let's set the table with the headline numbers. Because they didn't just meet expectations.
No, they cleared the bar by a pretty wide margin. For the full year, 2025, revenue was $52.5 billion.
Which is up 10.1%.
Right. And on the bottom line, earnings per share EPS came in at $15.45. That's up over 13%.
And just to frame that for you, Wall Street analysts, who get paid a lot to guess these things, were looking for lower numbers. GD beat revenue by over $600 million.
Handily. They beat on the top and the bottom line. But honestly, the revenue and EPS, while great for today, they aren't the most important numbers in this whole report.
Which brings us back to where we started, that backlog number.
Exactly. That 118 billion figure is a record. It is up 30% year over year. I mean, think about that. For a mature industrial giant, a 30% jump in your order book it's just unheard of.
And it gets bigger, right? You were telling me about something called total estimated contract value.
Yeah, which is even crazier. So the backlog is funded, signed orders, total estimated contract value includes all the options on those contracts. If you like the first 5, here's the price for the next 5 kind of thing.
Ah, so it's the potential follow-on work.
Precisely. And if you include those options, the number balloons to $179 billion. That is a safety net that stretches, halfway into the next decade?
There's a metric that I think really illustrates this whole idea. Better than just the raw dollars. The book-to-bill ratio. We should probably unpack that.
Yeah, it's vital, and it's actually really simple. Think of it like a fraction. Bill is the bottom number. That's what you shipped out the door. Your output, book, is the top number, the new orders coming in.
So if the ratio is 1-to-1...
then you're treading water, you sold 1 tank, you got an order for 1 tank, you're stable.
Which is fine for most businesses. You want to at least be at 1.
Right. But General Dynamics, for the whole year, across the entire company, was at 1.5.
So for every dollar of product they shipped, every jet, every tank they took in $1.50 in new orders.
Exactly. They're filling the bucket significantly faster than they can empty it. And that means growth isn't just a hope for the future, it's already locked in. Assuming, of course, they can actually build it all.
Well, that's the perfect segue. Because execution means very different things depending on which part of this company you're looking at. You've got the private jets, the land combat stuff, and the shipyards.
And the technology arm, yeah. But the big 3 are the real story here.
Let's start with the glamorous one. Engine number 1, aerospace. We're talking Gulfstream.
The Gulfstream gold rush.
It really feels like it. I mean, for a few years there, the narrative was that business travel was doomed. Zoom was taking over, companies were cutting emissions.
Right. But these numbers, they tell a very different story. People want new planes, specifically the new G700 and G800. Aerospace revenue for the year grew 17%. 17.
But it wasn't a perfect straight lineup. I saw some chatter about margins dipping in the fourth quarter. Operating earnings were down about $104 million from Q3.
Right, and this is where you have to go beyond the headline table. If you just see earnings down, you think, oh no, costs are out of control. But when you listen to the call, the explanation from Danny Deep, the president, is way more nuanced.
It sounded like a mix of bad timing and some accounting stuff.
A mix of bad timing and accounting quirks, exactly. First, the timing. They delivered 3 fewer G600s than they planned. When each plane costs tens of millions, just 3 deliveries slipping moves the profit needle instantly.
Okay, that's a normal manufacturing hiccup.
Yeah.
But the tariff part was what really caught my eye. $41 million in 2025.
It's a big number. But the fascinating part is how they account for it. There's a mismatch in timing between when the cash goes out and when the cost hits the books.
Okay, walk us through that.
So the cash leaves GD when the raw materials arrive. They have to pay the tariff right then to get the aluminum or whatever into the factory. So the cash is gone. But that expense doesn't hit the profit and loss statement right away. It sits in inventory. It only gets recognized as a cost of goods sold when the finished plane is delivered to the customer months or even years later.
Oh, I see. So the profit hit they took in Q4 was for cash they actually spent, like a year ago.
Precisely. It makes the margins look artificially squeezed in that moment. But even with that pressure, the demand signal is just deafening. Gulfstream had its second-best order quarter since 2008.
Since 2008.
Yeah.
That's pre-financial crisis numbers.
Correct. And back then, they were selling a totally different family of aircraft. Now they're seeing huge demand across the board, Fortune 500s, individuals, you name it.
So engine 1 is running hot. Let's pivot to something a little more kinetic. Engine 2. Combat systems.
This is where the numbers just stop being strong and start getting genuinely wild.
We said the book-to-bill for the whole company was 1.5. But for combat systems alone, tanks, ammo, what was it in Q4?
4.3 to 1.
4.3. That seems impossible.
It's just explosive order activity. That's the word Phoebe Novakovich used, and she does not use hyperbole. For every single shell or vehicle they delivered, they booked orders for more than 4 more.
And we need to be clear where this is coming from, because this isn't just the U.S. Army, is it?
No, not primarily. This is a European story. What you're seeing in these numbers is the paper trail of a fundamental shift in European security.
So who's buying what?
It's a laundry list of rearmament. You've got Germany ordering $4 billion worth of Eagle tactical vehicles. You've got Norway and the UK dropping $600 million on bridge systems.
Bridge systems, that seems less exciting than a tank?
Unglamorous, but so critical. You don't buy tactical bridge systems for parades. You buy them when you're planning to move heavy armor across rivers where the infrastructure might not be there anymore. It's about logistics in a contested fight.
That's a really sobering point, and Canada's in the mix too.
Yep, $640 million for light armored vehicles. It all paints a very clear picture. These are not just maintenance orders. These are armies realizing their stockpiles are way too low for the current threat level.
Speaking of stockpiles, we have to talk about munitions.
Ugh.
There's a story every other day about the global artillery shell shortage. What's GD doing there?
They are the backbone of that effort in the U.S., and they are ramping up fast. Phoebe gave some very specific numbers about their plant in Northeast Pennsylvania. For the last year, they've been making 36,000 rounds a month.
36,000 a month? Is that a lot?
Historically, yes. In a high-intensity war, it gets used up very quickly. But the real news isn't the 36,000. It's the new capacity. They've just established the ability to load, pack, and assemble 50,000 rounds a month.
So they're getting ready to produce almost double what they were just a couple years ago.
They are moving as fast as physics and safety will allow. The constraint now isn't money or orders. It's literally physics. How fast can you forge the steel?
Amazing. It really does come down to that, which is a perfect transition to engine number 3, the heaviest metal of all, marine systems, submarines. Now, this has historically been the trouble child, hasn't it?
Troubled child is a fair way to put it. For years, every earnings call was about labor shortages, supply chain delays, problems at the shipyard.
I mean, building a nuclear submarine has to be one of the most complex things humanity does.
It is. Zero margin for error. But this quarter, it really looks like the tide has turned.
I see what you did there.
Had to. But seriously, Q4 operating earnings for marine systems were up 72.5%.
Whoa, okay, hang on. 72%. How is that even possible for a business that big and that old?
Well, you have to look at the comparison. Last year's Q4 was particularly bad, so the comp is a little flattering. But you can't dismiss the real improvement. And the key metric to look at is something they call tonnage.
Tonnage. Okay, explain this. They don't just measure success by submarines delivered, right?
Exactly. A sub takes 7 or 8 years to build. If you only counted deliveries, your revenue would be zero for years and then billions all at once. So instead, they track tonnage. Literally, how many tons of submarine did we build this quarter? Did we weld the hull sections? Did we install the reactor?
It's a way to measure actual progress on the factory floor.
It's a measure of throughput. And Electric Boat, the subdivision, increased their tonnage production by 13%.
So they're actually working faster. The factory is getting more efficient.
The factory is working. And that 13% is the proof that the billions they've invested in the shipyards and in training their workforce are finally paying off.
And the orders are there to back it up.
Oh, absolutely. They just got awards for 2 more Virginia-class subs and another Arleigh Burke destroyer. The backlog is enormous. But there's always a but.
Here come the friction points.
It's never smooth. While the shipyards are getting faster, the supply chain is still what they call the gating item. They can only build as fast as their slowest supplier can deliver a critical valve or pump.
And speaking of friction, there was that weird detail in the technology segment, the IT stuff. It was totally flat. Zero growth in Q4. And the reason was kind of ironic.
This was one of the most fascinating nuggets in the whole call. You expect friction from supply chains. You don't expect friction from the Department of Government Efficiency.
The DOG.
That's the one. Management explicitly said that the Department of Government Efficiency's review of contracts slowed everything down early in the year.
Wait, hold on. The department created to make government more efficient actually slowed down growth because they paused everything to review it.
That's the irony. In order to find waste, they had to, metaphorically, stop the assembly line. It meant money wasn't flowing, new orders weren't being signed, and revenue just stalled.
It's like slamming on the brakes on the highway to check if your engine is running efficiently.
Yeah.
You might find something, but you're definitely slowing down traffic.
A perfect analogy. And you add in the long continuing resolution, budget delays from Congress, and the government itself was the biggest headwind for its own technology sector.
That's wild. Okay, so looking ahead to 2026, we've got these 3 huge engines firing. What's the plan? Are they just going to coast on this massive backlog?
Coasting is not the word I would use. Spending is the word. The revenue guidance for 2026 is solid. 55 billion. Steady growth. But the big story is CapEx. Capital expenditures. They're planning to spend over $900 million more in 2026 than they did in 2025.
Wait, a 79% increase in investment spending?
Yeah.
Why? Wall Street usually hates that. They want buybacks.
Because they have to. You can't sit on a $118 billion backlog and just hope you can get to it. They're pouring money into the shipyards for the new subs. They're pouring it into the ammo plants. They're spending money to build the physical capacity to deliver on that mountain of orders.
So they're building the machine that builds the machine.
Exactly. And here's the magic trick. Even while spending almost $1 billion extra on factories and tools, they are still targeting a 100% free cash flow conversion rate.
So they're generating enough cash from operations to pay for this massive expansion and still have plenty left over.
Correct. They are earning to build, not borrowing to build. It just shows you the raw cash power of this business right now.
So let's wrap this up for the listener. We have a company sitting on a mountain of orders. We've got Europe buying tanks like it's the Cold War again. The world's elite are buying jets like the economy is booming. And the shipyards are finally figuring out how to build things faster.
That's the summary. But I think the takeaway goes beyond just GD's stock price. It's about the signal this all sends.
Cool.
General Dynamics is a bellwether. When they report numbers like this, they're telling us the world is becoming more kinetic, that's the defense spending, and more mobile, that's the jet spending. And they are so confident that this trend is real, they're betting nearly $1 billion of their own dollars to keep up with the pace.
They are not betting on a slowdown.
They're betting on a very busy, very complex decade. And they're positioning themselves to be the industrial engine for it.
It's fascinating.
Yeah.
But you said there was one question that was still lingering for you.
Yeah, something to chew on.
What's that?
We just talked about the friction points. We saw the Department of Government Efficiency actually slow things down. We know Congress delayed the budget, which delayed orders.
Right. Bureaucracy getting in the way.
So here's the thought I want to leave you with. GD is ramping up to make 50,000 rounds of ammo a month. They're increasing submarine tonnage by 13%. The industry is doing its part. The private sector is mobilizing. The factories are speeding up.
But can the government keep up with them?
Exactly. Are we looking at a future where the defense industry's biggest bottleneck isn't the factory floor anymore? What if the real bottleneck is the speed of government bureaucracy itself?
That is a slightly terrifying thought. The factories can build it, but the government can't sign the paperwork fast enough to buy it.
Then that $118 billion backlog just sits there. It's a race between industrial capability and administrative capacity. And right now, it looks like the industry is winning. The question is whether the government can run fast enough to catch the baton.
A race worth watching. Thank you, as always, for guiding us through this.
My pleasure.
And to all of you listening, thanks for diving deep with us. Whether it's the jets, the subs, or just the economics, there is always more to learn. Stay curious. We'll catch you on the next one.